Xerfi Global has recently published a study on the European retail banking industry, which continues to face a string of woes in a weak market environment. It is true that the industry profitability improved from 2013 to 2015, supported by more selective lending and thus improved credit quality and lower loan loss provisions. This improvement is, however, set against a background of sluggish economic growth rates in Europe and other large markets in which European banks have interests, weighing on credit demand and lending activities, coupled with historically low interest rates, which typically generate a hefty proportion of banks' incomes. Furthermore, the banking industry continues to be subject to greater regulatory scrutiny and increasing liability, with stricter legislation with regards to risk-taking and increased capital requirements. Further disruption of traditional banking business models is coming from digital technologies. A snowballing number of financial technology companies have entered niche areas such as payments, lending, or wealth management, traditionally serviced by banks. Their competitive edge rests not only upon lower fees, but equally on provision of easily accessible digital services which enhance the customer experience, changing customer behaviour and adding an extra level of competition to the market. These elements combined lead to considerable pressure on retail banks. In this market environment, some banks have floundered while others have flourished. While some banks with a greater international presence and more diversified operations, such as HSBC or ING, saw fairly strong profitability from 2011 to 2015, Deutsche Bank's return on equity sat at 0%, dragged down by administrative expenses, impairment charges, and exceptionally high legal costs. While the Royal Bank of Scotland was even worse off, with losses due to litigation and conduct costs, as well as restructuring expenses weighing heavily on its profitability. European retail banks are responding to these pressures in several ways. So as to strengthen their balance sheets, they are taking cost-cutting measures such as layoffs, branch closures and sales of subsidiaries, and are sharpening their focus on core markets by disposing of risky or unprofitable assets, and are fundraising to boost equity and comply with capital requirements. In the era of ultra-low lending margins, they are also turning to fee-generating services and making targeted acquisitions so as to diversify into high-margin areas such as insurance or wealth management. A considerable focus is being put on technology investments, with financial technology companies often being targeted by acquisitions and partnerships. At the same time, retail banks are expanding their footprint in online and mobile banking to cater to the needs of increasingly tech-savvy customers. This move towards digitalization is reflected in the number of physical bank branches in the EU, which has been on a downward slide since 2008. In 2008, there were more than 237,000 physical bank branches across the European Union, while in 2015 this had decreased to just over 188,000 branches, a 20.8% contraction. However, closures impacted mostly developed markets, with the number of branches in Eastern Europe rising in excess of 13% over 2017 to 2015. This is because branch density is well below European averages, with Eastern European countries counting 2 to 3 branches per 10,000 inhabitants, as opposed to, for example, 7 in Spain. While the number of physical branches will continue to decline amid increased rationalization and digitization of distribution, online and mobile banking platforms will nevertheless complement rather than substitute traditional branches. The latter will increasingly focus on providing more sophisticated financial services, such as loans and financial advice.